Steve here. All right, you've done your homework, you've got your charts marked up, and now it's time to pull the trigger. But when you open that order window, you're hit with a choice, a really fundamental one: market or limit. How you answer that, well, that pretty much defines how you execute your trades.
You know, this choice really boils down to your trading personality. Are you a chaser? The kind of trader who sees momentum and has to get in right now? Or are you a sniper? The patient operator who sets their trap and waits for the market to walk right into it. Let's break down the tools for both.
So first up, we have the market order. This is the main weapon for the chaser. It's for the trader who says, speed is everything. You use this when you see a market moving hard and fast, and you believe that getting on board immediately is way more important than fussing over a few pips.
Think of a market order as a direct command. You're essentially shouting at your broker, hey, I don't care what the exact price is, just get me into this trade now at whatever the best price is you can find.
Okay, let's make this real. You're looking at the EUR/USD, and you see this price flashing on your screen, 1.1607. You're convinced it's headed higher, and you do not want to miss the move. So you hit that buy button. That action right there, that's a market order.
But here's the trade-off, and it's a big one. The pro is fantastic. You are guaranteed to get into the trade. It's instant. But the con? That's where the danger is. You have absolutely no guarantee on your price, which opens you up to the risk of slippage.
And that risk of getting a bad price, it gets a whole lot bigger when markets are volatile. For instance, think about the time right before a huge news event, like tomorrow's NFP report. The market gets thin, it gets jumpy, the price you see on the screen might be long gone by the time your order hits the server.
So what is slippage exactly? It's just the gap between the price you thought you were getting and the price you actually got. You might click buy at 1.1607, but in that fraction of a second, the best available price jumps to 1.1609. That 2-pip difference, that's slippage. It's the price you pay for the certainty of getting in.
All right, let's flip the coin. Now we're talking about the limit order. This is the tool of choice for the sniper. This is for the patient, precise trader who cares more about price than speed. It's perfect for ranging markets or when you want to buy a pullback at a very specific level.
A limit order is an instruction, but with a condition attached. You're telling your broker, look, I only want to buy if and only if the price comes down to this specific level I've picked out, or even lower. It's all about taking back control.
Let's go back to that Euro-USD example. The market is trading at 1.1607, but your analysis tells you it's probably going to pull back a bit before it takes off. You're thinking, I don't want to pay retail for this, I want to buy the dip. So you place a buy limit order way down at, say, 1.1580, and then you wait.
And here's the trade-off for being a sniper. The pros are all about precision. You get the exact price you wanted or better. No slippage, period. But the con is a heartbreaker. There's absolutely no guarantee your order will ever get filled. The market might come down, miss your price by a single pip, and then rocket higher without you.
So let's just lay it all out. For a market order, your priority is speed. Execution is guaranteed, but slippage is a real possibility. For a limit order, your priority is price. You get no slippage, but your execution is not guaranteed. It really is a simple choice between getting in now or getting in at the right price.
Now, there's another type of order that kind of plays by its own rules. These are stop orders. They aren't about getting a better price, they're all about catching momentum.
At first, this sounds completely backward, right? A buy-stop order is placed above the current price. I mean, why would you ever intentionally want to buy something for more than it's worth right now? Well, the answer is simple. You're waiting for a breakout.
Here's how it plays out. Imagine there's a heavy resistance level just above the current price. You place your buy-stop order just on the other side of it. If the market shows enough strength to punch through that ceiling, your order gets triggered and you're in the trade just as it's taking off. You're basically hopping on the train right as it's leaving the station.
When it's all said and done, the choice comes down to this. A market order, that's a hammer. It's brute force. It's about getting the job done right now. A limit order, that's a scalpel. It's about precision, patience, and waiting for that perfect moment to make a clean, calculated entry. So the next time you're about to enter a trade, just ask yourself, is this a job for the hammer or for the scalpel? You've already done the hard part, the analysis. Now it's about execution. Choose your tool wisely. This is Steve. I'll see you at the open.